Hello traders, you're welcome back to the Forex Geek channel. Are you struggling to find the best trade entries and exits in the Forex market? The Fibonacci retracement strategy is a powerful tool that can help you identify key price levels with trade precision. All right. Now, if you have any prior experience using the Fibonacci retracement levels, then you will know that it can be quite effective. Now, in as much as this strategy does not guarantee profit, it could be a valuable addition to your trading toolkit. Okay? So in this particular video, we are just going to break down how Fibonacci retracement works in Forex trading, how to draw Fibonacci levels correctly, the most important Fibonacci levels for you to watch, and a step-by-step strategy to use Fibonacci in real-time markets. Okay, so we're just going to be breaking these down. So make sure you stick around until the end so you don't miss any crucial details. Now, before we dive in, smash that like button and subscribe for more Forex trading strategies. Okay, so now let's just quickly get started. Now, the Fibonacci retracement tool is based on the famous Fibonacci sequence. It's based on the famous Fibonacci sequence, a mathematical pattern found in nature and financial markets. Now, in Forex trading, it helps traders identify potential reversal levels by measuring how far if a price pullback might go before continuing in the original direction. Now, these retracement levels act as areas of support and resistance, okay, where price is likely to react. The key Fibonacci levels are the 23.6%, the 38.2%, 50%, 61.8%, and 78.6%. Now, the 23.6% shows a shallow retracement or a weaker level. The 38.2% shows a moderate retracement, which is often used for trend continuation. Then the 50% level shows a psychological level. It's not officially Fibonacci, but widely used. Then the 61.8% is the golden ratio, one of the strongest levels. Finally, the 78.6% shows deep retracement, the last chance before trend reversal. Now that you understand the Fibonacci levels, let's just go over how to draw them correctly on your chart. To get accurate Fibonacci retracement levels, you just have to follow these simple steps, okay? First of all, you have to identify the trend, all right? You have to identify the trend. That is the first thing to do, okay? Once you have identified the trend, right? Once you have identified the trend, you determine whether the market is in an uptrend or a downtrend. Then you find the swing points. Locate the most recent swing high or low. For example, this is recent swing high, recent swing low, right? Now, you draw your Fibonacci retracement. In an uptrend, you draw from the swing low to the swing high. Okay? That's in an uptrend. So we're going to draw, this is the low, this is the high. So you draw from the swing low to the swing high. Remember that we used a trend line to identify this, right? So we're going to be drawing from this low to this high, okay? Then in a downtrend, you draw from the swing high to the swing low, okay? Just the reverse. Then you watch how price reacts at the Fibonacci levels. These act as support or resistance zones where price may bounce or reverse. Now let's talk about how to trade using Fibonacci retracement. Here is a simple yet effective strategy to trade using Fibonacci retracement levels. The first thing is to identify the trend, like I already said. If the market is making higher highs and higher lows, it's an uptrend. If the market is making lower highs and lower lows, it's a downtrend, okay? So you draw your Fibonacci levels, apply the Fibonacci retracement tool from the swing low to swing high in an uptrend, or from swing high to swing low if it is a downtrend. Okay, let's just look for a downtrend. Okay, for example, this is a downtrend. So in the case of a downtrend, you're going to be drawing from swing high to swing low. All right, something like this. Right, from swing high to swing low. Then you wait for retracement to a key level. You wait for retracement to a key level. The best retracement levels to watch are 38.2%, 50%, and 61.8%. Now, these levels often act as strong areas of support or resistance. Then after that, you look for confirmation signals. Okay, combine Fibonacci with candlestick patterns. Okay, watch out for maybe doji or pin bar or engulfing patterns or any other candlestick patterns that you can find. All right, and then you can also use your manually drawn horizontal support and resistance zones, okay, for additional confirmation. And you're going to notice that most of the times the Fibonacci levels are going to align with those support and resistance zones. Can you see? You can see that they are even aligning. All right, and then in addition, don't forget to use trend lines. Okay, don't forget, trend lines are very important. Don't forget to use your trend lines. And then you can also use moving averages for confirmation, additional confirmation. Maybe you can add the 50 EMA, for example, just to confirm signals. Okay, then you can enter your trade. You can enter a buy trade at the Fibonacci support level in an uptrend. For example, as we saw this pin bar, you can see this weak rejection around 38.2%, and you can see that around this point it was also being rejected by this horizontal support, and this trend line is also confirming that there is a dynamic support around here. And at this point, you can see that the price rose above the 50 EMA. So this would have been a good place to enter a buy trade. All right. Then if it is for a sell, you can set, you can sell at also Fibonacci resistance levels that is in a downtrend. Then for your stop loss, you can place your stop loss below the significant support zone where rejection took place. You can set it below that. All right, that's for a buy. If it's for a sell, it's going to be above. Okay, the reverse is the case for a sell. Then for a take profit, just target the previous swing high if it is a buy trend, or a previous swing low if it's a sell trend. So by following this step-by-step approach, it's going to help you to take high probability trades using Fibonacci retracements. Now, many traders misuse Fibonacci retracement by making these common mistakes. The first is drawing Fibonacci on small price swings. Always use major swing points for accuracy. Okay, if you want accuracy, use major swing points. All right, and then it's also bad to trade Fibonacci levels blindly. Always wait for confirmation signals before entering. All right, and then do not ignore the overall trend for any reason, because trading against the trend lowers your success rate. And finally, do not forget risk management. Okay, always use a stop loss to protect your capital. By avoiding these mistakes, you can use Fibonacci retracement more effectively in your trading strategy. And that is how you use Fibonacci retracement like a pro in Forex trading. If you found this video valuable, smash that like button and subscribe for more in-depth Forex strategies. Drop a comment below. Do you use Fibonacci in your trading? Let me know your favorite setup. I would love to hear from you. In the meantime, thank you for watching, and I look forward to seeing you in the next video. Happy trading.